See, and then I got this.
Happy Friday, everyone. How we doing? Anybody have a class after this one? Oh, so just Drew? Just Drew. Okay. So with the exception of Drew, I stand between you and the weekend, you know. So it's not going to make a difference to one of you, but for everybody else. So, yeah, I take that responsibility seriously. You hear me talking about that all week or all semester, and yeah. I hopefully to bring the enthusiasm in with Fridays. You just like say, I want to end this week on a high note, and not just like, okay, let's just let this be over quickly. You know, that's the wrong approach to this particular course. We're going to start chapter 3 today, which are going to be some technical concepts with respects to engagement acceptance. Quick reminder. So I looked at the assignments. It looked like everybody got through. Okay, I noticed a few people are having trouble with ID assignments. So just a quick reminder, if you are having trouble with an assignment or technological issues, just make sure you reach out to me and let me know. I'm pretty forgiving earlier in the semester getting the assignments in. I know everybody's trying to get organized with all their other courses. So if you have run into a problem, we can work it out. It's not like it's do or die type scenario, especially since we're in the first week of the semester. For IDEA, it's not required that you download IDEA on your computer. You can just use the remote desktop. I know a lot of people are trying to download, which is fine. But if you run into technical issues and just are worried about getting them resolved, then you can also make sure that you can look onto the computer lab. It's also available from remote desktop. I just wanted to make that note just in case you run into any problems in the future. I think once they get it up and running and get things working, it's not a problem for the rest of the semester, but the early barrier to entry can be a problem. Last thing to note, we are not meeting on Monday. I suppose if you want to come into class, if you want to come to the classroom on Monday, the doors may be unlocked, I'm not sure, but we will not be having a class session on Monday. We will be reconvening on Wednesday. We will be concluding chapter 3 on Wednesday, and we have our first discussion assignment on Wednesday. Now, just as a reminder, the discussions are not really assignments in the traditional sense. There is no deliverable, nothing that you need to submit for this. You do need to complete the requirements for the discussion. It's posted on Brightspace. It's actually set up as a quote-unquote assignment on Brightspace worth 0 points, just so people can have access to the detailed information. So answer the questions, do the necessary work that's ready, and then we'll talk about this on Wednesday, so everybody will be ready to go. Today, we're going to be talking about client continuation acceptance. I've got the homework up here, but we got some things to talk about before we get to that. So we're going to be starting out at the very beginning of the audit. And as we might think about what's the beginning of an audit, we need to think about how we are going to plan the audit. What are we going to be doing with planning? Now, planning is a massive phase of the audit. It takes a lot of work. We're probably not going to give it as much as it's due, as much credit as it's due, but we will talk about the important points and the important aspects. And one of the very first things we need to talk about is we need to talk about how do we go through the process of accepting new clients or continuing with existing clients. Now, something you need to keep in mind, and this will be very relevant next Wednesday, is that we as auditors are also business people. We are offering a service to our clients. In order to be able to make money, we need to be able to have clients to provide that service. So there is a big incentive to try to accept new clients. That being said, there may be situations where we say the risk is too high, we cannot accept a new client. It's like any service line. If you think the client is going to be a contentious problem, or you think there's going to be issues with the client acceptance, you may say, I don't really want to accept this job. So this is what we're going to think about when we think about whether or not we want to accept a new job or continue on with an existing job. Because usually what happens when we have an audit, an existing audit, it will recur for the foreseeable future. There may be some situations where it's not going to be the case, but we'll talk about those. So let's talk about the easiest scenario. We're going to be dealing with a client that we have never audited before, and they have asked us to do work for them. They want us to do the annual financial statement audit. So what are the things that we need to consider before accepting a new client? So first things we need to determine is, are we capable as an accounting firm of performing the engagement? Now, at a very basic level, this is a simple question, but there's a lot that goes into this. First of all, we do need to be capable of performing the audit. And secondly, we do need to be able to scale according to the size of the audit. The easy example to think about is that if we had a CPA firm in here at Kirksville, there are several of them, would they be appropriate for doing an audit like Amazon? Probably not. Amazon's one of the largest companies on the globe. It probably has thousands of personnel assigned to it in various capacities of audit. I would say that it'd be very, very difficult for a CPA firm here in Kirksville. I made the joke into my graduate class and said we could take every single person in Kirksville and it probably still wouldn't be a large enough staff for the Amazon audit. So that is one of the considerations we have to consider is, do we meet the staffing requirements for the engagement? Next, do we comply with the legal and relevant ethical requirements? Now, the legal requirements are pretty straightforward. We have to be able to follow the law and be able to follow the staffing requirements, the regulatory requirements within the area. We're going to talk a little bit more about that as we move forward, about the idea of if we're doing a public company audit, what are the requirements with registration for the PCOB that we have to meet? And so that's something we have to consider. Ethical requirements are a little bit more subtle and distinct. For right now, we're going to talk about this concept of independence here in a little bit. That is going to be our primary concern is, are we independent of the client? We're going to get into a lot more depth on that as we prepare for the second exam. We start talking about the Code of Professional Conduct. I alluded to that on Wednesday, but for right now, all you really need to focus on is, are we independent of the client? That's kind of our biggest ethical concern. And then also we need to consider the integrity of the client. And keep in mind that we are basically trying to find out whether the management team has done the job that the owners have tasked them to do. If the management team does not bear integrity, if they are not one of those groups that we can trust, it may be a difficult task for us as auditors to do our job. So we do need to consider the integrity of the client. As far as prospective clients, if they have previously been audited, that's actually a boon for us. Now, it's not always going to happen. We may have to start from square one and say, this is a client that's never been audited before. We're going to have to do everything from the beginning. But let's assume that we have a client that has been audited before, and we are taking over the audit from another auditor. There are some things that we have to do as the successor auditor to talk to the previous or predecessor auditor before we can accept the engagement. First of all, we're going to talk about management integrity for the reasons we just discussed earlier. We also want to know any disagreements that occurred with the predecessor auditor in management. We also want to make sure we understand any communications that occurred with corporate governance between the predecessor auditor and the client. So corporate governance, we talked about on the Wednesday. Can you remind me what that is again? So it's the board of directors, but there's a subset of the board of directors that we talked about. What was the two words that we talked about? We're going to talk about that more today. It's the audit committee, okay? The audit committee, okay? We also want to know the reason for the change in auditor. Now, this may seem like something really, really nefarious and brutal, but it may be something very basic. Think about Amazon earlier. Does anybody know what Amazon started as when they first went into business? They weren't like the purveyor of all things online.
Did you start at the garage?
Yeah, that's eBay.
Yeah, like bookstore.
A bookstore, yeah. In fact, I remember when I was in college and undergraduate, I bought my books on Amazon. I said, well, this is really convenient. This Amazon is going places. Yeah. Now they basically sell everything online and have got the 2-day shipping, which I can take way too much advantage of. So anyway, they've grown over the past 2 decades, and as a result, their requirements for auditors has probably grown as well. When they were just a small public company, they probably had a regional auditor. Now they are one of the largest companies in the world, and they're going to be one of the big 4 auditors who's going to be doing the audit for them. I honestly don't know which. I probably should. And then we also need to know about related parties and unusual transactions. Put a pin in that. We're going to talk about the idea of related parties here in a little bit, okay, and what our requirements are as auditors. So yeah, there's some things that we want to talk about with the predecessor auditor. Make sure we have clear understanding of what their communications and what their interactions were with the client. All right, what if we were the predecessor auditor? We're not going to give up our role. We want to try to determine, we want to continue on the audit. What is the questions that we have to ask? So this is called client continuation. And this is what you're going to be doing, by the way, as part of your discussion for this coming Wednesday, is making determination. Are we going to continue with the client? So we're going to evaluate the client retention periodically. This will usually occur at the near audit completion, so the end of an audit, or if a significant event occurs. Now, the audit completion is pretty straightforward. That's pretty obvious. Once we complete an audit, we're in a good position to evaluate, do we want to continue doing this work in the future? But the significant event is also important to note. Say, for example, there's a merger or an acquisition. That is going to change the context of the audit. So we may want to reevaluate at that point as well. 2 primary concerns come up with respect to client continuation. Now, this is not a comprehensive list of the reasons that we might question client continuation, but these are the 2 most prominent issues that come up. The first one is, are there conflicts over accounting issues, accounting and auditing issues? If we try to do our job and we're constantly arguing with management over what it is that we're trying to do and what they need to do, it may not be worth it for us to continue on as the auditor anymore. The second one is a little bit more subtle, but it's pretty obvious once you think about it, and it's dispute over fees. Keep in mind that we as auditors, we have a requirement for the amount of staffing and the amount of work that we have to do, and as a result, we have to pay our personnel for that. If the client refuses to pay us what we believe we're worth, then it's probably not worth our time to continue auditing for the client. And it seems so petty. It's like, well, you're not paying us enough, we're going to leave. But let's be honest, that's the way that we work in the real world. I think if anybody in this room, if they went and started working for a job and they get an offer that says, we're going to pay you $12,000 a year, you'd probably be like, thanks, but no thanks. I think I'm worth a little bit more than that. Okay. Yeah. Think about it like 50 years ago, 12,000, you'd be like, whoa, what a deal. Yeah. But yeah, $12,000 nowadays, you all are worth more than that. Let me tell you right now. Okay. At least 13.5, at least 13.5, at least that. All right. So, let's go ahead and get into the preliminary engagement activities. Let's assume that we have decided we are going to continue on with an audit, okay? Whether this be a new audit or whether this be an existing audit, we are going to go to audit. And this is an important point because we have to continue, because if we say no, we don't have anything basis to work from. So the class just ends today, which would be a nice early Friday, but you wouldn't learn anything. So since you're paying me to learn, let's go ahead and learn some stuff. So what are some things that we need to know when we talk about preliminary engagement activities? First thing we're going to talk about, we need to determine the engagement team requirements. Okay, determine the engagement team requirements. There are some special questions that we have to ask here about, first of all, some of them are basic, like what is the size of the engagement team we need? How many do we need in each position? Like how many partners, how many managers do we need? How many staff do we need? Some of them are a little bit more distinct. Do we need specialist auditors on the engagement? Is this a particularly difficult audit? Is anybody familiar with oil and gas accounting? Has anybody done oil and gas accounting? I've audited multiple oil and gas clients, and I'll still tell you, I'm still not familiar with oil and gas accounting. Okay, it is one of those. It's like a Rubik's cube. Okay, you only really know it if you practice it a lot. So yeah, that's one of those things we do know. We might need a specialist in there to be able to answer certain questions. Also, we need to ensure compliance with ethical and independence requirements. Some of these are pretty basic, and independence is a pretty important issue, as we talked about before. And so our ethical concerns are going to be related to whether we have an existing relationship with a client. How petty can we be on this? How small do we have to think about this? Let me ask you a question. Let's assume that I'm an auditor and I have a client that has past due audit fees that are over a year old. Can I continue working for them as an auditor? Like, well, we don't know, Dr. Barnes. We just started this class this week. It's just like, why would I ask this question? So what did you learn from 303 about payables when they become over a year old? What do they have to be classified as? Have to be classified as long-term, specifically like notes payable or something long-term. When you ever have a long-term liability, what is implicit associated with that? Interest, implicit interest. If we have an interest ownership in an organization, or if we have an interest basis in an organization, we have an ownership in that organization. If I own part of a client that I'm auditing, can I be independent of that client? Seems kind of silly to say, well, the payable's over a year due. I can't audit the client because I partially own it. But that's one of the things that auditing standards tells us. So it becomes very, very minute when we think about things like that. We also need to establish an understanding with the entity. Now, there are 3 ways that we're going to be able to do that. The first of these is going to be called an engagement letter. Second is going to be called how we evaluate the work of the internal audit function. And the third is going to be the role of the audit committee. Now, if you didn't get all those down, don't worry. We're going to go into all 3 of these in detail here. Okay. So first of all, what do we mean by the engagement letter? What does that mean? Well, obviously, taught something like this. It's lovely. It's great when that happens. Okay. Not that type of engagement. Not that type of engagement. So that's not the last time I'll make a bad joke in this course. So get ready for it. Okay. There are audible groans I hear. So an engagement letter is detailed in the book. And basically, this is a contract between the client and the auditor. Okay. The way it's described, I believe it's on page 71. This letter serves as a contract outlining the responsibilities of both parties. Now, we don't need to know all the concepts or all the contents of an engagement letter, but we do need to talk about some of the most important components, the things that are always present in an engagement letter. So there's 3 sections that I want you to note. And by the way, if you go and look at this in the book, it's 3 pages long. There are a lot more areas, a lot more sections of these 3 components, but these 3 areas that I'm going to be talking about, these are the most 3 important areas that I want you to know. The first of these is going to be the objective of the audit. What is our goal here as the auditor? What are we trying to accomplish? We need to outline that within the engagement letter. The second of these is going to be management's responsibility. Now, we're going to say this a lot throughout this course, but management is responsible for the presentation and preparation of the financial statements, as well as the design, implementation, and maintenance of internal control. So management creates these things that we as auditors are going to audit. They create the financial statements, they create the internal controls. That's management's responsibility. And trust me, if you didn't get that all down, preparation and presentation of financial statements, design, implementation, maintenance, internal controls, trust me when I say we will have plenty of opportunities to talk about those particular concepts. For right now, all you really need to think about is management creates the financial statements, management creates the internal controls. They're responsible for those, okay? To pair off of that, our third section is going to be auditor's responsibility. So we know management creates the financial statements. They create the internal controls. What do the auditors do? The auditors check the financial statements and they check the internal controls. More accurate word would be say that we test those. We test those to make sure that they are representative of what management says they are. Okay. So 3 areas: objective of the audit, manager's responsibility, auditor's responsibility. And knowing, understanding the difference between manager's responsibility and auditor's responsibility should kind of be your first big picture task. Next, let's talk about this thing called the internal audit function. So remember when we were talking on Wednesday and I said the focus of this course is external audit. But I also mentioned that there's another party that kind of can be related to audit called the internal audit function. And I said internal auditors are employees of the client and they constantly work for the client. They are representatives of the client. They're there the entire year, whereas we as external auditors are usually only there for a period of time during the year. So it probably makes sense the internal audit function knows a lot more about the inner workings of the clients than we do. We're going to talk a little bit about the internal audit function and what they do, some of their responsibilities a little bit later in the course. But right now you should know that the internal audit function, these are representatives of the clients that are there consistently, and they do a lot of work for the client. Now, let's think about this just from a logical perspective, okay? Let's say you're working on a project and you know somebody else is working on a similar project who has a lot more work done than you. Would you want to leverage their skills and their knowledge to try to help you with your knowledge? Seems like a good idea. Says Dr. Barnes, that's cheating. It's like, no, okay, we're assuming that it's not cheating, okay? Assuming that it's a legitimate exchange of knowledge, and you find somebody who has got a lot of work done in an area and they were willing to share their knowledge in that area. Sure makes sense to leverage that possibility. That's what we want to do as external auditors. If possible, we want to leverage the experience and expertise of the internal audit function. To do that, we have to answer 3 questions, or we have to check 3 criteria as the external auditor. The first, we need to understand the extent to which the internal audit function's organizational status and relevant policies and procedures support the objectivity of the internal auditors. A simpler way to answer this is say, is the internal audit function objective in their responsibilities? So when I'm talking about objectivity in this, I'm talking about, are they impartial? Are they free from bias and influence? Can they do their job without management skewing their work or skewing their perspective? Secondly, we need to understand the level of competence of the internal audit function. If we're going to rely on the work that they do, we want to make sure that they know what they're doing, that it makes sense, okay, that they are skilled at their job. The third one is a little bit muddled. It's a little bit confusing, but it's this idea of the application of the internal audit function of a systematic and disciplined approach. And basically all this is saying is the responsibilities and the work that is done by the internal audit function, the way they approach it makes sense, okay? It's intuitively sensible. We can follow it as auditors. It's not like one of those conspiracy boards with the red yarn floating from coast to place where you can't figure out what everything's linked. We need to have a very clear path on the understanding. So in case you want to summarize this, objectivity, competence, systematic, and disciplined approach. That's the easy way to think about that, okay? 3 things that we as external auditors have to evaluate if we want to utilize the internal audit function. All right, the final one we talked about, the final one of those 3 items that we talked about was the audit committee, okay? So we alluded to this already on Wednesday. The audit committee is a subcommittee of the board of directors, all right? And I want you to make a note of this because this often comes up as confusing. But for non-issuer companies, there are no specific requirements, okay? For privately held companies, there's no specific requirements as regard to composition of the audit committee. Now, does everybody understand the distinction I'm making here? I'm saying for these private companies, they can have whoever they want on the audit committee. Why am I making that statement? Because that's not true for public companies, for issuer companies. The rules of the PCAOB are pretty distinct, okay? Or I should probably say more appropriately, the rules of the Sarbanes-Oxley Act are very distinct. So does everybody have their own copy of the Sarbanes-Oxley Act available? If you don't, you should have that. All good accountants should have the Sarbanes-Oxley Act. Guess what's on Brightspace for your perusal? Sarbanes-Oxley Act, okay? So on page 32 of the Sarbanes-Oxley Act, it says the following. Each member of the audit committee and the issuer shall be a member of the board of directors of the issuer and shall otherwise be independent. And it does some discussion about what that means, okay? And then talks about their fees and they're not an affiliated person of the issuer, subsidiary thereof. So that means that if you are going to be on the audit committee, you cannot also be an executive of the company. You cannot be on the management team, all right? And you can't receive compensation outside of that of your role as on the board of directors. So the CEO cannot be on the audit committee for a public company. Now, again, the distinction is this requirement does not apply to non-issuer companies. This only applies to issuer companies, but it's a really important criteria we understand. All members of the audit committee have to be independent in their role. They can't be on the management team. What else did I say on there? So what else did I say? So that was the first criteria, Sarbanes-Oxley Act, Section 301. And then I said Section 407 requires that at least one member, at least one person has to be a financial expert. So what does a financial expert mean? Well, handy dandy Sarbanes-Oxley Act, page 46 should have this. All right. So the term financial expert, education experience as a public accountant or auditor, as a principal financial officer, comptroller, or principal accounting officer, or an issuer for a position involving the performance of similar functions. And basically, it's the functions of understanding of generally accepted accounting principles and financial statements and the preparation of audited financial statements of generally comparable issuers. So you need to actually be in a role of management on the audit team or in a position of financial work as a comptroller, CFO, controller, whatever it may be, during an audit. That is what's required to be a financial expert. So, to my knowledge, there's nobody in this room, including myself, that would be considered a financial expert underneath that. So, while we can serve on the audit committee, we cannot be the financial expert. Says, Dr. Martins, weren't you a manager? Says, yeah, I was a manager for like 1 month before I left KPMG. So, that's not really fair. But yeah, I was a manager at KPMG for like a month, and then I went to get my PhD. So, yeah, that's space. So yeah, important criteria for this. And again, keep in mind, these are PCAOB requirements or Sarbanes-Oxley requirements for the composition of the audit committee. But it's a really, really important one that we need to understand. Okay, so let's go ahead and talk about the details of audit strategy and audit planning, okay? Now, it's important to distinguish that these are related concepts, but not the same thing. An audit strategy is basically helping the audit determine what resources are needed to perform the engagement. Whereas the audit plan is more detailed than strategy and talks about how to conduct the engagement in an effective and efficient manner. That being said, we use a strategy and we incorporate that into our planning process. Okay, our overall strategy is to incorporate how we go into planning. So what are some steps in planning with respect to that? So the first thing we're going to need to understand is assessing business risks. Now, this will become more important when we start talking about internal controls. But business risks are pretty obvious because these are going to dictate the scope of the audit and some of the concerns we have with respect to the things that we need to do over the course of the audit. We also need to establish materiality, which we're going to talk about more on Wednesday. Materiality is a quantitative threshold for which we use as decision-making in the audit, okay? How do we establish that quantitative threshold? The answer is nobody knows, not even me, okay? It is very subjective. So while we're dealing with objective numbers, the way that we go about determining those objective numbers is a very, very subjective process. And so, yeah, important to note. We need to consider multi-locations. All that basically means is if the client operates in more than one area, then we need to understand how do we audit multiple areas. We need to assess the need for specialists. I mentioned that earlier. If we talk about a client that's got a very special business model, we may need to actually have people who are understanding or specialists in that area. If we're talking about financial instruments and very, very difficult to understand financial instruments, financial details, we may need to apply the work of an actuary. We also want to consider the violation of the laws and regulations, okay? And we consider these to be illegal acts, which we're going to get into a lot in chapter 4. But as a baseline, we need to understand the auditor has a responsibility to plan the audit and provide reasonable assurance of detecting illegal acts that have a direct and material effect on the financial statements. So the question is, what is the auditor's responsibility for fraud? And the answer is, if fraud has a direct and material effect on the financial statements, then we are responsible for as auditors for planning procedures that could detect those items. Now, the question always comes up, does that mean that if a fraud takes place and we as auditors don't detect it, that we've not done our job properly? And the answer is, it depends, okay? Like every good question, okay? It depends. It really depends on the size and the scope of the audit, or the size and scope of the fraud. If it's something that we think is very small, even if it's material, it could be something that said, we as auditors, we did our best to find that. It's reasonable that we would have missed it. We're talking about something like Enron, where it should have been very, very obvious, and it was obvious that there were red flags that the auditors just ignored. That would be something they couldn't get out of, regardless of how much they tried to beg and plead, okay? So it's situational. We also need to identify related parties, which we're going to talk about a bit in just a second. We also want to consider consider the possibility of additional value-added services. We talked about this on Wednesday a little bit. So what is the problem with value-added services? And the answer is because we as auditors have to be independent of our clients, that restricts the amount of value-added services we can provide. Now, there's a bit of a trade-off there, because if we can't provide additional services, then we are going to be independent in fact and appearance. On the other hand, when we're doing our audit, we are gaining knowledge about a client, knowledge that could be potentially useful in other capacities. So there's an information loss in that particular situation. Now, what is the answer? Should we auditors be allowed to do more than just auditing their clients? It really depends on the situation. The answer 20 years ago was a hard no. The answer nowadays is we're not sure, okay? So that's a really, really important question. If we can provide additional value-added services, it might be worthwhile for us to be able to do so. We also need to document the overall audit strategy, the audit plan, and prepare audit programs. We're going to talk more about documentation in chapter 5 and how we go about that process. Suffice to say, we're going to scratch the surface on that. We're not going to get too deep, although you will have regular exercises throughout the semester that will allow you to look at what audit documentation looks like, okay? In fact, I think that's going to be part of what we're going to be doing on Wednesday when you're looking at the audit documentation. A little bit of what you did for the homework today. All right. One of our last things we need to talk about, what is a related party? Okay, what is a related party? So a related party, basically defined, is any individual or entity that has an existing relationship with a client. Okay, an existing relationship. Now that is a little bit problematic, and so we could say that a customer or a vendor already has an existing relationship. When we're talking about a relationship, we're talking about something that's a little bit more than just an existing business relationship. It's more familial in nature, a familiar relationship in nature. An example of a related party would be somebody who's literally related. So like the CEO does business with his brother. So the CEO's brother does business with an audit client. That's really, really problematic because they may be getting favorable terms if they have an existing relationship. The way that we characterize that from GAAP purposes and for audit purposes is that related party transactions are frequently not characterized at arm's length. Now, what does arm's length mean in this context? Let's say that you engage in an honest contract with somebody that don't have any pre-existing relationship with, and you come to terms and you say, let's go ahead and let's agree upon this. How are you going to commence the transaction? Reach out, shake hands, okay? That's arm's length right there, okay? Now let's say that you do a contract, you engage in a contract with your mother, okay? And you say, okay, we've come to terms, we're going to agree. Are you going to reach out and shake hands with your mother? Like, yes, Dr. Barnes, we're very formal in my family. No, you got to reach out and give a hug. It's closer than an arm's length transaction, okay? That is kind of the depiction that's being made here. So transactions that are not at arm's length have very specific requirements under GAAP, and we as auditors have some goals in that regard. So we need to make sure we understand the relationships and transactions at a very basic level. We would like to be able to identify that these transactions do occur at least a relationship of arm's length, even if they're not an arm's length depiction. So they're representative of other transactions. More importantly, the most important point is we have to ensure the transactions have been properly evaluated by management and they always have to be disclosed in the financial statements. All related party transactions are required to be disclosed in a company's financial statements. So we as auditors have responsibility to make sure any related party transactions we identify get disclosed. If they do not disclose related party transactions, if management fails to do so, that is a violation of generally accepted accounting principles, which we'll talk about more about what that depicts here in a little bit. Okay. So moving forward, we're going to be talking about risk assessment procedures. We're going to start that in week 3, my apologies. Then we're going to be talking about substantive procedures in chapter 5. Then we're going to have an exam, and then we're going to get a little bit more in depth about test and controls. Okay. Now, we're going to be talking about testing at a very general level when we start talking about substantive procedures. It's a substantive procedure in chapter 5. So it's going to be applicable to both test and controls and substantive procedures. The reason I mention that is that there's going to be certain types of tests that we can perform, both the substantive procedures test and test of controls. They do need to be modified slightly to the nature of the procedures being performed. But overall, if we can perform them simultaneously, we can do something called dual purpose testing. So even though we're going to separate out these two phases of the audit and we're going to distinguish those, in practice, the way they work in reality is oftentimes these take place kind of simultaneously, these test of controls and substantive procedures. Now, that's not going to make any sense when we get to chapter 4, and we're going to talk about the process of risk assessment. And you're going to say, that doesn't make any sense now, Dr. Barnes. These can't take place simultaneously because we have to distinguish one before we can determine the other. And you're going to say, you're absolutely right. It is a little bit confusing. So right now, just basically say it's confusing, and we'll just go ahead and use that as our template for moving forward. Okay. All right. That does it for chapter 3, part 1. Let's go ahead and talk about the homework. So an independent audit adds value to the communication of financial information because the audit does what? Now, one thing that I'm going to caution you about, and this is true for any question in any course that you take, not even just accounting courses or auditing courses, but any course, be very, very careful of absolute answers, okay? When you see a word like guarantee or exact accuracy, you should probably be very, very cautious that that's not correct. That's not correct. Now, I'm not going to say it's 100% of the time. I'm going to say most of the time that'll be the case. We tend to shy very heavily away from absolute answers, particularly in this course, okay? There's going to be a lot of very, very imprecise answering in this course, and it's going to be very, very frustrating. Believe me when I say that I've been doing this for 10 years, and it still frustrates me, okay? So that's something to want to be very, very cautious about. But this one's pretty straightforward because there's only one answer that's not really absolute, and that's B, lends credibility to the financial statements. All right, 114. Which of the following best describes the reason why an independent auditor is often retained to report on the financial statements? So, as we talked about, lending credibility to financial statements is really, really important. But at a basic level, we need to understand that this credibility has a demand from one party. Remember that relationship in the principal-agent relationship we talked about, where the owners say, we need information from the agents. The agents provide that information in the form of financial statements. But then the owners say, how do we know these financial statements are correct? That's where we jump in as auditors and say, we can answer that question for you. So what is that depicted as? Different interests may exist between the entity preparing the statement and the persons using the statements, thus outside assurance and need to enhance the credibility of statements. So that word credibility comes up again. Interestingly enough, I don't know that credibility will come up at any other point in this chapter. That's a really, really interesting term that they use it in this chapter, and they don't ever use it again, but maybe it'll come up. Somebody keep an eye on that. See if we see credibility come up as an answer again in future chapters. I don't know that it will. All right, 115. Which of the following best describes the relationships among auditing, attest, and assurance services? Those are the 3 ovals, okay? What was the outside oval? Does anybody remember? Assurance. That's the big one, okay? And then the middle oval, that's attestation, and then auditing is a very specific series of procedures in the middle. Now, auditing rules, we're going to spend an entire semester talking about that, and by the time you're done with this course, you're going to understand an audit is very specific to testing financial statements and testing internal controls, providing reasonable assurance, and basically what the scope of our work is. But it falls under the scope of the other areas. So which of the following best describes that relationship? Auditing is a type of assurance service. It's a very specifically defined type of assurance service, but it is a type of assurance service. All right. Question 118. All right. Which of the following statements best describes how materiality is related to audit evidence in a financial statement audit? Now, this first answer, A, This is one of those ones that I still get a laugh out of, which shows you just how silly I am because, no other person, not even accountants are going to look at this and say, that's a funny answer. Should be say, okay, yeah, whatever. But I just look at that and say, oh, material from which the audit evidence developed. Oh, that's clever. That's clever. That's not the answer though. Okay. So it's going to be either B or C, the higher level which the auditor assesses materiality or the lower level which auditor assesses materiality. The question is, what does the relationship look like? Okay. What does this relationship look like? Let's go ahead and answer this question. Let's answer this question through kind of a basic area. Let's assume that I want you to tell me what the amount of money that you have in your bank account is. Okay, I want you to tell me that. Now, I'm going to tell you. I'm going to ask you this question without saying, okay, just give me an assessment within the nearest $1,000. How many people think they could do that just off the top of their head? Pretty confident, huh? Right? So off the top of your head, you could say, I'm pretty close that I have $1,000. If I have $1,000 in my bank account, Dr. Barnes, I'm within the nearest $1,000. You could probably be pretty confident on that. So you don't have to do a lot of work to answer that question. Can we say make that assessment? What if I say I want it within the nearest $100? Is that a little bit more of a challenge? Yeah. Still, I have $100 in my bank account, Dr. Barnes. I'm a college student here. So yeah, still very reasonable, but a little bit more challenge. What if I say I want it within the nearest 10 cents? Now you have to do a lot of work to get to that point. So what does that tell you is that the amount goes smaller. What does the amount of work related to that amount do? It goes up, okay? As materiality becomes lower, the work that we do as auditors becomes greater, okay? So there's an inverse relationship between those two concepts. Now, if you didn't know that now, don't worry. That'll become very obvious when we talk about materiality on Wednesday. But for right now, you just think about the fact that as the number gets smaller, our work becomes greater. 121, this is another one of those questions that I laugh at. Okay, what is meant by an unqualified opinion? Okay, an unqualified auditor's opinion indicates the auditor is not qualified to express an opinion. Yeah, so that's not unqualified. That's just that's what I find funny. I find weird things funny. Okay, that's all I'm going to tell you. You got to find your humor somewhere, guys. Yeah. So anyway, what do we say about unqualified opinion on Wednesday? Is that a good thing or a bad thing? It's a good thing. It's a clean opinion. It means that there are no qualifications to be made to the report. So we're looking for an answer that represents a good statement. So an unqualified auditor's opinion indicates that an auditor's opinion of the financial statements are fairly presented in accordance with agreed upon criteria with no need for inclusion of qualifying phrases. This agreed upon criteria is a little bit suspect. Did anybody look at that and say, that's not what we talked about before? What agreed upon criteria do you think we operate under PCAOB guidelines? Better question is, what is the method of reporting that most companies use in the United States? GAAP, generally accepted accounting principles. That's our agreed upon criteria here. That's going to be the ones that we're talking about in most of our scenarios in this course, okay? So even though that's fancy language, it's just basically saying presented according to GAAP, generally accepted accounting principles. The reason I say most companies is that IFRS reporting is also allowed under PCAOB guidelines, but we're not going to really talk about that in this course. All right, 123. A client has used an inappropriate method of accounting for its pension liability in the balance sheet. Resulting in the statement is material, then the auditor does not consider the effect to be pervasive. The auditor is unable to convince the client to alter its accounting treatments. The rest of the financial statement is presented fairly in the auditor's opinion. What kind of report should the auditor issue under these circumstances? So let's just answer this question before looking at the answers, okay? We talked about two types of deviations that could occur. One is a departure from generally accepted accounting principles. The other is a scope limitation. Which one of these is represented here? A departure from GAAP or a scope limitation? Departure from GAAP. The client's not following the rules of financial reporting, okay? Now, we know that that's going to result in either a qualified opinion or an adverse opinion. Qualified is basically saying it's important, but it's not extreme. Adverse is saying it's extreme. Based on the language used in the problem, is this an extreme problem? No, they say it's not pervasive. That's the word that we use, auditors use as extreme, okay? So this is going to be a qualified opinion due to a departure from GAAP, okay? Qualified opinion due to a departure from GAAP. Going to chapter 2, a few questions here, okay? Which of the following statements best describe management's and the external auditor's respective level of responsibility for public companies' financial statements? This is a reflection on what we talked about earlier. This is something we want to know, okay? So what did we say earlier? We said management has a responsibility for what for financial statements? Kind of creation of financial statements, okay? The preparation and presentation is the wording that they use in the language, but creation of the financial statements, preparation and presentation. I get those transposed. And what is the auditor going to do? They're going to test this, okay? They're going to check this and make sure. What do we provide when we check that? We provide reasonable assurance. So let's look at C. Management has the primary responsibility to ensure the company's financial statements are prepared in accordance with GAAP. It's consistent with what we talked about. And the auditor provides reasonable assurance the statements are free from material misstatement. So management creates in accordance with GAAP. We check and make sure they are in accordance with the GAAP. We make sure we provide reasonable assurance to that regard. All right. The Public Company Accounting Oversight Board, PCAOB. What are they? Well, they're a subset of the SAC. And remember, we talked about this. We said they're a public company. They're responsible for setting standards for public companies in the United States. So they are a quasi-governmental organization that has legal authority to set auditing standards specifically for audits of public companies. By the way, does anybody remember what I said the name of the company was that sets them for non-issuer or for private companies? ASB, yes, Auditing Standards Board, which is a subset of what organization everybody's familiar with? The AICPA. Very good, very good. Okay. Now, again, our focus is going to be on PCAOB audits, okay, but we do need to make sure that we know both sets of standards. Last question. This one's a little bit of a dicey question, but I do think it's an important one to talk about. This is a very early introduction to these concepts, but it is in the first chapter. So you were recently hired by the CPA firm Hansen & Hansen. Before you start working, the firm requires that you participate in a first-year staff training course. They want you to prepare information for the following questions. So the first two questions I want to answer together jointly because these are related questions. So what is audit evidence, and how is the collection of audit evidence related to management assertions? So let's answer this question by talking about management assertions. What are those assertions we talked about? Remember those list of 8 items I said you don't need to know yet, but you do need to know that they're important? They are very important, by the way. The answer is that whenever management puts information in the financial statements, they are making representative assertions about that information in the financial statements. Now, the example I used was inventory. Does everybody remember the inventory example? I said if inventory is a line item in the financial statements, management is saying this inventory exists and it is properly valued. Okay. So that is the assertion point. And we know that as auditors that these assertions exist. What are we supposed to do as auditors? Yes, we are supposed to test those assertions. And what we're going to find when we get to chapter 5 is the way that we test is we gather evidence. In fact, the terms audit evidence and audit testing are going to be synonymous to one another. They're going to be used interchangeably. So audit evidence is a method of testing the financial statement assertions. Okay. So how would we do that? So I think Carter said earlier when I talked about assertions, I said, how do we test existence? You said, observe the counts of inventory, which is a very good way to testing existence. Okay, if we're observing the counts of inventory, we can make sure that inventory actually exists. We're actually going to go through the process of an inventory count when we get to chapter 5. It's not too difficult, but the process itself does follow some very specific steps for specific reasons, and those are related to these concepts of assertions. We're talking about valuation. We want to make sure we understand what is the price of the inventory and is the amount on the books consistent with the price of that inventory. I say price, I should say cost. That's a more appropriate term because price implies selling, cost implies buying. But regardless, we're testing those assertions. We need to understand how can we gather evidence to verify those assertions. Now, this one's a little bit more subtle, and you may have to do some research on this one, but what are 2 key characteristics of audit evidence the auditor must consider when evaluating the quality of the evidence? So this one's problematic in that you probably found 2 terms, and then if you did a little digging, you found 2 more terms, okay? So let's go ahead and talk about the basic qualifications, and we will talk about this a lot more when we get to chapter 5. But you may have encountered 2 terms called sufficiency and appropriateness, okay? Now, sufficiency basically implies there is a sufficient quantity of evidence, that are basically the correct quantity. Appropriateness, by virtue of that, probably implies quality, okay? So if you've identified sufficiency and appropriateness, that's basically what those terms mean. And those are very important terms, ones that we're going to anchor on a lot here in a few weeks. We're going to talk about them again, and we're going to get to a little bit more depth in talking about those. But the reason that I want to mention this is that this specifically talks about the quality of audit evidence and actually asks about quality of audit evidence, which means that we really want to focus on this idea of appropriateness. Now, appropriateness is defined by 2 additional terms, okay? Relevance and reliability. So if you did a little bit of digging, you may have found that. And if you didn't find that, that's fine. It's not a big deal. This is why we talk about this in class so that we get this. So appropriateness is defined by the concepts of relevant or reliability. In other words, audit evidence needs to be relevant, not elephant. It needs to be relevant and it needs to be reliable. Now, that sounds intuitively correct, but let's think about that just really, really quickly. We got like 4 minutes, so we can talk about this, okay? So if I say audit evidence needs to be relevant, then we probably need to say what does relevant mean in this context? So let's go back to that inventory thing. We're talking about, I'm concerned that inventory exists, all right? If I gather evidence that confirms the completeness of inventory, is that relevant evidence? Well, what was my assertion that I said I wanted to test? I said I wanted to test existence. But then I said I gather evidence about completeness, which is a different assertion, okay? It's important evidence, but it's not relevant to the assertion that I'm being tested. So relevant means that it signals the true state of the assertion I'm concerned about. Now, quick note, I don't want anybody jettisoning completeness right now and say, well, completeness is irrelevant to inventory. Dr. Barnes said it, it must be so. Completeness is still important for inventory, okay? But if I'm specifically in a situation where I want to test the existence of inventory, I can't rely on a test that validates completeness. Those are two different concerns, two different items. In fact, when we get to the late part of the semester, we're going to look at a revenue process and we're going to look at a misstatement of revenues. And we're going to find a test that was trying to validate existence of revenues where somebody relied on completeness testing. I'm going to come back on this and say, remember we talked about this and say you can't use one to proxy as the other. Relevance is important that we know which assertion we're trying to identify and the testing we identify related to that. And then reliability is a little bit more concerning, or a little bit more straightforward. Can we rely on the evidence? And the answer is, it really depends on the nature of the evidence. Some of it's pretty easy. If I say, I want information about the current period under audit, you give me information from 10 years ago, we can probably say that's not very reliable evidence, all right? It's also not very relevant to evidence. But reliability has got a definition all its own. When we get to chapter 5, what we're going to note is that certain types of evidence are more reliable than others. And what does that mean? Well, for example, we've got one type of evidence that's called inquiry. Now, when you hear the word inquiry, what does that mean to you? Just ask somebody a question, okay? So let's say I ask you a question and you don't want to give me the correct answer. Are you just going to say, well, it's Dr. Barnes, I better not lie to him? Or could you say, well, I'm just going to bear complete false witness to Dr. Barnes and he's never going to be any the wiser, okay? So inquiry basically is less reliable because if we make an inquiry, somebody could tell us something that's false, okay? They could not tell us the truth, all right? What if instead I decide to go into records and documents, or I decide to go into reperforming a particular type of audit test, I do the work myself instead of relying on your assessment? Which is going to be higher reliability, the assessment I get from you or my testing to make sure that I understand that? By the way, I'm not going to be digging into your past anytime soon. I don't want you to get afraid of that. But I'm saying, if that were the case, if I did the testing myself, would that be higher reliability than relying on just your verbal statement? Probably so, okay? So the reliability of audit evidence is going to depend on what type of evidence we have. And again, you don't need to worry too much about that now. It's actually a pretty simplistic concept, and we're going to have a very, very easy acronym for understanding. But the introduction to this is really, really important. All right, have a good extended weekend. See you all on Wednesday.